Hi, everyone. I hope you're all doing well. Thank you very, very much for joining us today for our end of tax year webinar. I hope you're all doing well. My name's Luke. I'm the client experience specialist here at Crunch, and I'm joined by Michael Awuye, our technical and regulatory accountancy manager. I will try and keep this within the hour, I promise. We do try our best to do Q&As as well, but there's quite a lot that we have to cover this time round. If you've been to one of our events before, they're usually relatively straightforward. However, this year, there has been some notable changes that you should all be aware of. So we'll do our best to keep within the time frame and have time for Q&As as well at the end. So let us quickly give you a summary of what it is we're going to cover. Now, it's worth also noting for those that don't know Michael or I've been with Crunch for about 8 years now. Michael, I believe you're the same?
No, 6 years, I believe.
6 years. Okay, so we've got good combined experience between us, so we can walk you through what you need to have done before the end of the tax year. So that's literally just around the corner. And then we're going to try and give you the best advice possible so that you're set up into the new tax year so that you've got everything that you need to have a good financial successful year. So without further delay, here's a brief summary of what we're going to go through. As you can see, it's quite text heavy, this, but Michael and I will do our best. There are the slides available to download, so by all means, download them at your own leisure and read through them later as well if you want to. So for closing the tax year, so the end of this year, first point are all your ducks in a row. So we're going to cover your responsibilities, whether you're a limited company or a sole trader. Make sure that you've got everything tied off before the end of the year. We'll also go through some changes to corp tax and something called associated companies declarations. This is more of a reminder. This actually we covered last year, but we'll briefly explain what those changes are just to give you a refresh. We're going to go through some updates as well to things like confirmation statements, national living wages and VAT changes. Those are some big ones, so do keep tuned in for that. And then, of course, just making sure that you've got things like allowable expenses, your invoices, any tax breaks are being utilised. And then the last couple of points, obviously, is really closing off the period with income for directors, so being tax efficient. And then, of course, the famous self-assessment as well. Going into the new year, what we're going to look at is the autumn and March budget statements. There's been some changes there, so that's worth sticking around for. Again, personal allowances, rates and threshold changes, tax efficiency once more. And we'll also talk briefly about the benefits of maybe sole traders going limited. And the last few points, obviously, with childcare benefit changes and obviously expenses once more, alongside some more changes with Companies House. So without any delay, let's get stuck right into it then. So the first thing that we're going to talk about is responsibilities for limited starting off. Now, Michael, I'll defer to you for some of this as well, but there's really some key things that limiteds need to have tied off, isn't there, before the end of play. So we've got, firstly, the final payroll submission. So, Michael, if you could give us a brief explanation of what that is.
Yeah, what basically happens is that we've been filing payroll for clients for a while for the tax year, so it's 12 months anyway, so most people are doing it on that basis. So this is basically the one that's like seals it all off, and then all adjustments are done on that one. That's the final one before P6s and the rest are all completed. So that's what the FPS is mainly about anyway.
Perfect. So that's just, in summary, closing off the 12-month payroll period.
Yeah.
And it's in a way, it's kind of a declaration, isn't it, to HMRC to say, I've paid all my 12 months. This is my last one. You can deem this as final in that case. Yeah. Cool. Lovely stuff. So yeah, don't forget to do that. If you are a Crunch client, that's going to be relatively straightforward to do in your account. If you're on one of our packages, you do it at the same time as actually filing your last payroll. So it's just a little tick box exercise. But for those that don't, do keep it in mind. It may be something that you need to, if you've got like a government gateway account with HMRC for your business, might be something that you need to check on there. The other one, of course, is P60. That kind of goes hand in hand with the FPS. That's, correct me if I'm wrong, it's a summary, basically, of the entire tax year. And that will be things like salary paid to date, taxes paid to date, all that kind of stuff. And that's for your own records as well, isn't it? So HMRC has a copy. You also have a copy at home.
Yeah, exactly.
Excellent, excellent. P11D. For those that don't know what a P11D is, this is called a benefit in kind form. So benefits in kind are things that you receive on top of a salary. So this could be things like a company car, medical insurance, I believe is another one. Anything that it's a perk that you get on top of your salaries. So the deadline as highlighted there is the 6th of July. So you've got time on this one, and you can actually start filing your P11D from the 6th of April. So you have to wait until the tax year finishes first, and then you can do your P11D afterwards as well. If there is any tax due on a P11D, you have to pay that by the 19th of July. Michael, did you want to add anything about P11D? Anything I've missed?
Yeah, the tax due you're referring to, that's the one for the benefits in kind, the NI bet. But then the P11D itself, the directors and employees who would need to include that income on their self-assessment tax return when they are doing it. So it's one of the documents we expect that people would submit as part of their income when they are filling in our questionnaires and the rest.
Okay, brilliant, brilliant. I've just got a quick question here from Sabrina, which is quite relevant to what we've just talking about with, I believe it's referring to the FPS as well. So should we finalise all the payment for salary before the next year? I'm going to say the answer to that is yes in that case. So that will literally be, as long as you've made all your salary payments and you've paid it before the 5th of April, so you've closed that all off, that will then be your final payroll submission in that case. Is that correct? Yep.
Yes.
Excellent. Okay, perfect. Oh, one quick one actually from Micah as well. Trivial benefits are not included on the P11D. Can you confirm?
No, they are not included. Basically, once they match the rules, so it's like vouchers, no more than 15 arrests, it wouldn't go onto your P11D because they are excluded.
Excellent, excellent. Perfect. Okay, Sabrina and Micah, hopefully that has cleared that off for you. There are, as I say, there are links and things as well on these slides. So if you do download them, we are going to send a follow-up for those that are wondering with the recording as well. So you'll have the video, plus you'll also have the slides themselves with all of these links on there for additional resources. Okie dokie. So new responsibility for limited, kind of new. It got spoken about last year, and this is something called Associated Companies Declaration, which did come into effect just before the close of the last tax year, so on the 1st of April. And in short, as it says at the top, it's defined by a company that's associated with another if at any time in a chargeable accounting period, one company has control of another, or if there's two companies that are under the control of the same person or group of people. So Michael, this is definitely more your area than mine. So perhaps you want to give a sort of a summarized version of what this is, because we know HMRC likes to make things very confusing.
Yeah, this is basically linked to the changes they've made to corporation tax. So as many people will be aware, the rates it used to be 19% flat. But now they've introduced the 25% rate, and then there is also a gap between the 19 and then 25. So they've introduced something they call the marginal relief. Now, obviously, what they've tried to do is that they want to make sure that the thresholds and the rest they've introduced, there are no gaps in between. So if you have someone who's basically having, let's say, 2 or 3 companies and the rest, they kind of link them all together and then basically use that to determine that you need to pay extra taxes or not. So this is simply if you are, let's say, a director shareholder with more than one company, basically this is targeting you. Okay. It doesn't include companies that are, let's say, dormant or non-trading, because basically you're not doing anything. But as long as you have another company, even if it's outside the UK, then this basically is trying to link them all together to establish what the threshold should be.
Gotcha. Okay. And this, again, correct me if I'm wrong, is more or less, again, for lack of a better phrase, a tick box exercise where it's basically just yes, no's. Do you have associations with another company? No or yes. And then you have to give the information about that if it's a yes.
Yes.
Okay, cool. Okay, brilliant. And I know with Crunch clients, it's more or less just a form. Some of you have probably already seen it pop up. I think we do it twice a year. So we'll do it once. You'll see it again in your Crunch account when the new tax year rolls over, but also just before the end of a accounting period if you're a limited company. Is that right?
Yes. The reason we basically do that is that if clients have seen their company tax return before, you would realize that in a section when it comes to computing your taxes, it does split it into different tax years. So the company tax year basically starts on the 1st of April. So it's like everything up to the 31st of March falls in one tax year, and then everything after the 1st of April falls in another tax year. So that's why you basically need to state whether you may have closed off one business within one tax year and the rest. So we need to know that kind of information to make sure that you pay the least amount of tax. If you don't tell us, you pay more.
Okay, brilliant. So it's in everyone's interest then to make sure those forms are done as early as possible to be as tax efficient as possible. Brilliant. And I'd imagine then for those that aren't Crunch clients, this would be something that they do on HMRC themselves?
If you aren't a Crunch client, you obviously need to speak to your accountant about it, because it's going to be very difficult for you to file a tax return without doing it directly. I don't know how you do it directly with HMRC anyway, because they are in charge of corporation taxes, not Companies House. So yeah.
Gotcha. Okay, brilliant. So if in doubt, speak to an accountant and they'll be able to advise you on what to do and where you could possibly do it. So cool. Okay. The next thing, as Michael actually was speaking about earlier, was actually some changes to corporation tax, which hand in hand goes with the Associated Companies Declaration that again took effect on the 1st of April, is there were some changes to corp tax. As Michael said, corporation tax is now sort of levied, I guess, for lack of a better term, where you have these different rates depending on the profits that you're making. So corporation tax for profits under 50,000 remains at 19%. There is a change then with profits between 50,000 and 250,000 that gets taxed at the main rate, the 25%. But then, as Michael alluded to, there is a marginal relief within those brackets as well. Is that right?
Yes. So just for clarity also, what we are currently looking at is applicable if you only have one company. So if we link it to the previous slide where we're talking about associates, assuming you have another company, so let's just say you've got 2 companies in total, rather than having the profits up to 50,000, it will profits up to 25,000. That will be taxed at the 19%.
Right.
Okay, so the number of companies you have would mean that the thresholds would be reduced by that. So because if you have 2 companies, then we divide the 50,000 by 2 and the 250,000 by 2 as well.
So this is in sort of real terms then is it's the 50,000 limit isn't per company, it's actually a combination of those, right? So you don't get individual rates now, it's all encompassed as one. So if you have two companies, it's 25 for one, 25 for the other one.
Yeah.
Gotcha. Okay, that makes sense. Lovely. And the last point on here as well, which hasn't existed before, is they increased the corporation tax for any businesses that make profits of over 250,000 to 25%. So quite a significant jump from 19%. And again, it's worth bearing in mind what Michael was just saying. If you have multiple companies, you would then divide that amount by the amount of companies that you've got there as well. Okay.
Yeah.
Excellent. So now this one is pretty significant. This is quite a big change that this is for Companies House, a Companies House change. So limited companies will be aware that every year you have to file something called a confirmation statement. And generally speaking, this has been quite straightforward. It's a summary of where your business is registered, who are the directors, things of that nature, shareholders, all that kind of stuff. Now, that has stayed the same. The sort of principle of the confirmation statement remains. However, there are some new mechanics that they've introduced to these confirmation statements, which came into effect on the 4th of March. So they want all companies now to provide contact info, for lack of a better term again, such as a registered email address. So Companies House will now be able to communicate with you directly. It's not going to be available to the public. So it's certainly not something that they'll post on the Companies House website, for example. It's just a way for them to contact you. You know, if you're a Crunch client or you have an accountant, they can still be contacted as well. It's just a way for them to get in touch with you personally, should they need to at any point. Now, if you're already an existing business, which I'd imagine a lot of us here are, then your next confirmation statement is when you'll need to include that email address. So just make sure that any email address you do provide them is you know, it's functional. It probably makes more sense if you've got one to have your business email address added to that instead, so that you can keep it all nice and tidy with the rest of your business. And for new companies, this will just be something that becomes the standard. So really the only significant change here is for those that already have businesses formed. Just be aware that you may need to provide some additional information on your next statement as well. Anything else further that I've missed on this one, Michael?
Basically, the idea behind this one is that as time is changing, I mean, the post doesn't come in as often as possible and the rest, so they want to go a bit more digital. So that's where this whole thing is coming in from. It was introduced as part of the economic crime bill, which came in towards the end of last year anyway. So, yeah.
Okay. I guess in some ways, some of you have probably been aware as well that even HMRC themselves have started moving to sort of digital platforms. You know, making tax digital was something that came into effect, I think, a couple of years, maybe 3 years or so ago now. So they are going through a little bit of a revamp on the way that they function and communicate with people that operate businesses in the UK, which is a good thing. Although there, as expected, has been some hiccups along the way, but they're certainly starting to smooth those out now. And get a better understanding of how they would like to do that. So for sole traders, it's a lot simpler. I will be completely upfront and honest. Sole traders do have it easier in the way that they can sort of wrap up their end of tax year. The only real things they need to do is make sure that you've got your expenses and your invoices and everything like that recorded. Now, there is two ways that sole traders account for their self-assessment, because that's all they need to do. And with your books, you can either do it via cash accounting or accrual accounting. So they're quite simple, actually, but I'll let Michael explain the key differences as highlighted here.
Yeah, so with a cash accounting, basically, as the name even implies, everything is tracked based on the actual movement of cash. So if you are paid, for services you've completed, that is when that income is recognized, and then it impacts your self-assessment. When you pay, let's say, a subcontractor or your insurance or your accountant, when that money leaves your bank account, that is when it actually impacts your self-assessment. So if you haven't received the cash, it basically isn't deemed as income on your self-assessment. Whereas if you go with accrual accounting, accrual simply means that the mere fact you've raised an invoice means that that invoice goes onto your self-assessment and is deemed as income. You may not have been paid, but then you are still going to be taxed on it. Now at Crunch, we basically prefer to do the cash accounting basis, and even the HMRC or the government is moving towards using cash accounting as a default process, because if you, assuming you've put an invoice, you've raised an invoice for, let's say, 10,000, you haven't been paid for it, you've put it down on your self-assessment as basically income, you are taxed on it, and then the client doesn't pay you. Now you've got to figure out how you actually get that money back after you've paid tax on income you haven't physically received. So the government is moving towards that, and from 2024, 25, that's going to be the way they would actually be processing most of the sole trade income in a way, or the self-assessment income.
Excellent. And that's fairer as well, right? Why you can't physically pay something that you haven't got yourself, can you? So you just end up in a bit of hot water. So that's a sensible move in this case. So cash accounting, definitely the safer option. You only pay when you've actually been paid is the long and short of it in that one. So good shout. And the last point as well is sole traders, of course, can do their self-assessment as soon as the new tax year begins. As we covered earlier, for limited companies, there's a few things that you need to make sure that you've got tied off before you do your self-assessment as well. So quite straightforward for sole traders. Allowable expenses and invoices. Now we'll cover this for all business types, so limited, sole traders. There are obviously some key things that absolutely everybody could and should be claiming for. So the key thing here is to consider the word allowable expenses. HMRC their definition of it is wholly and exclusively for business purposes. Now there's sometimes a bit of a blur between what is wholly and exclusive for business purposes and what they would consider something called, I believe it's duality of purpose. Is that right?
Yes. So if you can use the same, let's say, item for, let's say, business and then personal, then that's what we basically mean by it's got a dual purpose anyway.
Brilliant. So in that respect, then, on the wholly and exclusively for business purposes, that literally means just that: is this item only being used for your business? And that's generally what they would deem as an allowable expense. So things like equipment, of course, so you can claim for things like equipment. There's one funny example, actually, if we go to the duality of purpose, and it's a question that we don't get so much now, but we used to get, was clothing, for example. That was always a big question, is can I claim for clothing? And obviously the argument is, well, you're only going to wear that clothing while you're working. I mean, it's probably a 99% certainty that no, you're not going to. Obviously, that does differ slightly for things like uniform. Okay, so we're not saying you can't claim all clothing, but there is specific circumstances for clothing where you can. So anything that's uniform, generally speaking, you can do. Although, again, funny questions do get asked around this is, what about if I bought some clothing and branded it with my company logo? Arguably, that
you can claim that one.
Yeah, because it's marketing, right? It goes down as marketing cost.
So as long as, let's just, one of the ones that usually clients ask is, can I have put a suit and a rest? Can I claim that? And that was, the answer is obviously no. But as long as your suit, you've put some branding on there that maybe advertises your business and the rest, that you can claim, because it's for business. I mean, if you want to wear your business suits to a friend's house and then
I mean, are you going to brand a business suit, Michael? I don't know. I mean, it depends how expensive it is, doesn't it?
Yeah, but that's where that's the marketing bit or the advertising bit on there. So what I'm saying is that if you buy a standard suit, but then it's then branded to advertise your business, then that means that you are advertising your business. And in that case, you can claim that suit. Okay. But if you buy that same suit without any branding, then you can't claim it.
Can't do it. Okay. I think another one worth mentioning at this point as well is something that is another popular question we get is mobile phones. So sort of phone bills, things of that nature. Now, it's my understanding that if you're a limited company, if you buy the phone or you take the contract out under the company's name, then you can claim for that. Is that right, or has that changed? Yeah. You can claim for that.
Okay, as long as the contract is in the company's name. The company, remember, is a separate legal entity.
Yeah.
So the company can have a contract with a phone provider in its own name, and that basically is okay to claim.
Is okay. Okay, perfect. And also, just to I see a question here from Patrick. Do allowable expenses run April to April or the company year? So for limited companies, expenses will be between your company year. So that's accounted for in your company's accounting period, because those expenses will be, they reduce your corporation tax. So they reduce your profit and therefore it's tax deductible. And for sole traders, your expenses are accounted for between the financial tax year, which is the 6th to the 5th of April. That's right, isn't it?
Yes.
Yeah, perfect. Excellent. Can I think of anything else? I mean, computers, I suppose, is quite a popular one. So again, this would just go down as equipment costs. So if you're, a graphic designer, web designer, anything like that, or you just use, I think most of us probably do in this day and age anyway, you use a computer for your work. Generally speaking, that is going to be an allowable expense as well. The other thing I do want to just quickly clarify, quite straightforward, is to ensure that all of your invoices have been recorded. Just going back to my point earlier about, expenses are usually tax deductible, and that's whether it's from your company accounting period or for your self-assessment. You want to make sure that all of your invoices have been recorded. So you've got the correct tax calculations, you've got the correct deductions being made, and obviously it'll affect things like income tax, national insurance, self-assessment, and corporation tax and dividends for limited companies as well. Now we'll cover the sort of income, salaries, thresholds, things like that in just a tick, but hopefully that's cleared up some items for you all. Tax breaks, I'm going to swiftly defer to Michael on this one because this is absolutely his area, and he's got some great advice for you around these particular items.
Yeah, usually there are things you can invest in to probably save a bit of tax anyway. One of them is the ISA, which is 20,000 for the seniors. The juniors are usually 9,000. You can invest in ISA, and then basically any interest and the rest you earn from that isn't taxable. Pensions as well. The allowance used to be 40,000. They've increased that to 60,000 now. And with that, even if you haven't paid into pension going back 3 years, you're allowed to backdate as well. So especially with those paying through limited companies, if you know you are going to have massive profits and the rest, that's one of the ways you could also ensure that your profits come down, and then you're basically paying corporation tax at 19% rather than the 25 or above the 19% with a marginal relief anyway. But as always, we encourage you to seek specialist advice. Crunch is not regulated to give pension advice to the rest, so you do need to seek specialist advice on what pensions to get involved in and the rest. Okay?
So you'd have to go to an independent pensions advisor I think, at that stage to get some real definitive answers. Perfect. All right. Well, as I said earlier, we have got some resources down here. If you do want to read up on any of these points here, they can be extremely beneficial, as Michael's just highlighted. So I would encourage you to do that if you get a moment and can do that. Again, I'm going to pass over to Michael swiftly for capital gains and super deduction. These are other ways, other tax breaks. There are some changes in here that you should be aware of as well. So I'll pop you across back to Michael.
Capital gains is an interesting one for people to make decisions on, and you've basically got a short space of time to do this one now. For those who don't know, capital gains is the tax you pay once you dispose of assets. Now, the capital gains allowance used to be around 12,300. It's been reduced over and over, and it's now going to fall down from 6,000 to 3,000 for the 24-25 tax year, which starts sometime, I think it's next week or so, on the 6th of April. So it's currently the capital gains allowance is currently 6,000, so it's going to reduce to 3,000. So logically, what we'll be encouraging people to do will be to make sure that they kind of try and then dispose of some of their assets now to utilize that 6,000 before it expires by the 5th of April this year. However, they are also announcing that the capital gains when you dispose of a property, so that we're talking about a building, is basically they're going to reduce the higher rate from 28% down to 24%. So in as much as you would want to dispose of some of your assets, probably it would make sense if it's a property that you maybe delay that one till the new tax year, especially if you're a higher rate taxpayer, because you would get a bigger reduction next year compared to doing it this year. So assuming you have, let's just say maybe crypto or those kind of stuff, that might probably have, maybe you want to dispose of this year, that might be best. But then if it comes to a building that you own and the rest you want to sell, that's probably should be next year. So that's one to probably think about or have a conversation with an accountant if you're considering doing it. On super deduction, it's something that the government introduced at the time of COVID, and it was supposed to help businesses basically, or maybe boost the economy by encouraging businesses to purchase assets and the rest. That basically has ended or ended on the 31st of March. They indicated that they will be introducing a newer one. The newer one they've talked about is what they are calling the full expensing. But looking at the full expensing, it's not as generous as a super deduction, because it's currently just allowing you to claim just the 100% of the asset value, which is the same as what's existed before.
Right.
The super deduction gave you an extra 30% on top of the value of what you actually purchased. So yeah, that's it for the super deduction.
Perfect. Okay, so some good considerations there, particularly with the capital gains advice as well. Really solid advice on that one. So yeah, as Michael said, if you do want any info, do speak to your accountant. If you're a Crunch client, obviously give us a call, speak to us more about it as well. So I'm conscious of time, so I am going to quickly whiz through a couple of these. These aren't huge changes, but certainly things to be aware of. So national living and minimum wage rates do increase on the 1st of April. So as you can see here, all of them have risen. So for 21 and over, it's up to 1144, 18 to 20, 860, under 18, 640, and for an apprentice, it matches that as well. VAT thresholds. Now, this is the registration threshold. So this is at the point where you become required to be VAT registered. Previously, it was 85,000, and now it's 90,000. Michael, can we just confirm this is turnover, right? So this is 90,000 in turnover.
Turnover.
Right.
Yes.
Perfect. And for deregistration, that's moved from 83 to 88. So you have to deregister, you've got to be having a turnover of less than 88. What happens in between that 88 and 90? I couldn't tell you. I don't think HMRC knows. It's a weird thing to do. A little bit of a grey area on that one. But I'd imagine it's probably going to be down to their discretion if you do fall within that sort of couple of grand difference here. I don't know, Michael, if you've heard anything about it, or is it just a grey area?
Yeah, it's just a grey area. That's what the rules have always been.
Yeah. Okay, perfect. And then the last point on here was the furnished holiday letting is being abolished from next year. Okay, so that is one thing to be mindful of as well. So tax efficiency, now this really is for directors, and this is just to make sure that you are taking the most out of, you're making the most from your business before the close of play. So our recommendation is always going to be utilizing your personal allowance and the secondary national insurance thresholds. So for secondary national insurance threshold, you basically take up to 9,100 within the tax year as a salary. So that equals £758.33. You can then take up to 41,170 in dividends, and that will give you a rough estimated income tax bill on your self-assessment of about 3,200. Now, the way that we work this out is your dividends are broken down as follows. So you get 3,470 tax-free. Now, technically, you only get, and you get £1,000 tax-free as part of a dividend allowance. But what we do is actually use the amount between 9,100, which is the secondary national insurance, up to the 12,570. And that's the difference there. That's right, isn't it, Michael? That's how we calculate those.
Yes, yes. So everyone has got a personal allowance of 12,570. So if you don't, because you're paying salary of 9,100, you haven't utilized your full personal allowance. So the difference is what you're taking in extra dividends. And
that's all tax-free as well?
Yes.
Perfect. So yeah, that's easily the most tax efficient method. And then actually all you're going to be left with to be taxed on is the 36,700 at 8.75%. So extremely tax efficient way of making income. One thing to be aware of though is if you do dip over the 41,170, the jump is quite significant. As you can see, it goes up to 33.75. However, don't let that put the fear in you, because it's basically bracketed. So just because, let's say you take 42,000, that doesn't then mean the entirety of your dividends are going to be taxed at 33.75. It's just the amount that you're over. Okay, so they're sort of split by brackets, as I say, in that sense. Now, one thing I do have to caveat is these calculations are based on the fact that you don't have any additional income. You know, you don't have another side hustle that you're making money from. And you also need to budget as well. Do consider something called payment on account. Now, I'm not going to dip too far into the realms of payment on account. It's a dreaded topic. No one likes talking about it. But this is something that you should be aware of, where HMRC have almost this revolving door of money year on year, where they basically expect you to pay in advance towards your next year's self-assessment bill. For those that are already in the cycle, it's a bit less painful because you're probably used to it by now. But particularly if this is your first year, it might come as a bit of a shock to you to all of a sudden see, okay, so let's go on these calculations. You've got 3,200 as a tax bill. All of a sudden, HMRC want double that, which is what they will call the payment on account, where you'll pay half of that on top of your tax bill in January, and then the other half of it in July. So do be mindful of that. We have got resources, as I say, there's a link there if you want to find out more. It can trip people up and kind of put you off kilter for the new tax year, especially if you're trying to budget and plan and things. So do be sent, super wary of that. Speaking of which, going on to self-assessment now, for all of you here, you'll all need to do a self-assessment. You know, you have to report to HMRC what your earnings are. You have to declare how much it is that you've been earning or taking through your business, whether that's as a sole trader or whether it's a limited company taking salary and dividends. As we covered at the start, there's some key things limited need to sort. So as a reminder, final payroll submission, your P60s and your P11D, your benefits in kind. Sole traders, as I said, have it pretty easy. You can start doing your self-assessment as soon as the new tax year rolls round, the 6th of April. And again, if you need additional help, additional information, please check out our Help Centre and Knowledge articles to understand complexities. If you're a Crunch client, we can actually do this for you. It's a really simple process. You just fill in a simple questionnaire within your account, and actually most of that data, as long as you've been keeping things up to date and you've reconciled and got your invoices and expenses, will actually just pull through. So any sort of salaries, dividends, that kind of stuff will be taken from your account and put into the questionnaire for you. So pretty straightforward. Alternatively, you can go and do it on HMRC's website. Again, as we probably all know, they don't make things that easy to use. So we're here if you need us. Okay, so moving on to the start of the year. Now, there is quite a lot that we have to cover here. Again, conscious of time, so I am going to try and get through this in the best sort of concise but informative way possible. So national insurance changes. Now, there was first an autumn budget, and then we had the March budget. So for national insurance for employees and directors, in autumn, they reduced the national insurance from 12 to 10% from the 6th of January. In March, though, they then reduced it further from 10% to 8%, and that comes into effect on the 6th of April. For sole traders, so for self-employed, in the autumn budget, they declared it was going from 9 to 8%. But then in the March budget, they reduced it from 8 to 6. Now, both in autumn and March statements for self-employed, they said it was coming into effect on the 6th of April. Obviously, they then changed their mind in March. So what this really means is a reduction from 9% to 6% effective from the 6th of April this year. Okay. Was there anything else that I missed on this, Michael, or is it?
No, that's fine.
Excellent. Now, allowances and thresholds, not too much has changed in the previous years. There are a couple of things here. We've put in bold the things to make it easier to read. I'm not going to read this verbatim, but I'll whiz through it very quickly. So personal allowance stays the same. We covered that a moment ago. It was 12,570. The basic rate remains the same, 37,700. Primary threshold actually matches the personal allowance now. So this is the primary national insurance threshold, 12,570. Secondary threshold, which is what we recommend directors take a salary of, is 9,100 for the year. Now, this one has changed. So employees and director national insurance class 1 contributions has been reduced to 8%. And then if you enter the upper earnings limit, so once you start earning more, you will then pay, it's another 2% as well on top of it, isn't it?
2%, yeah.
Yeah, so that's almost bracketed out as like I said, dividends were, right? So you'd earn a certain amount and you'd pay 8% on that amount, and then you'd earn a certain amount in the upper earnings and you pay the extra 2%.
Yeah, upper earnings starts from the 50,270. So if you add up the 12,570, which is their personal allowance, plus the 37,700, you basically get out to the 50,270, which is all within a basic rate threshold.
Right.
So once you go above the 50,270, that's when you start looking at paying a 2%.
Okay, perfect. Thank you for clarifying. Excellent. Class 1, NIC, remains 13.8. I think this is the one nearly all of us are the most acquainted to, so that stays at 13.8. Dividend tax rates haven't changed either, so 8.75, then to 33.75, and then into the upper limit of 39.35. Now, one key change here, unfortunately, is that dividend allowance has reduced to 500, so they've slashed that in half. They've been doing this over the previous few years. I remember it started at it was 5,000, then they dropped it to 2,000. Now they've dropped it to 1. Now they've dropped it to 5. So what's in store for the following year? we can only assume, but we'll see when we get there. And the employment allowance towards national insurance remains the same at 5k. Okay. So Scottish tax thresholds and rate changes. Now, there has been some pretty big changes with this one in particular, as we saw for sort of most of us. Not really much has changed in the ways of thresholds for salaries, but particularly for Scottish residents, there has been some significant changes. So, Michael, did you want to walk us through what these ones were?
Yeah, so with the Scottish, usually they do change their thresholds regularly anyway. So you can see in a previous year, if you look at the starter rate, it was previously between 12,571 to 14,732, but then for the 24-25, they've basically increased it to 14,876. So you can see all the ones highlighted in red are showing where they've changed the thresholds between 24-25 and then 23-24. Additionally, they've also introduced a new band as well, which didn't exist previously, of income between 75,000 to 125,140. They've introduced that new band with 45% rate on there as well. But saying that, with the recommended salary, so if you have a Scottish director shareholder who's basically taking the recommended salary of the 9,100 and then the dividends, they would still pay the same 3,211, because these rates we see here, they are for income tax. So as long as the income tax, the 9,100, is still within this rate anyway, the dividend tax is not devolved to the Scottish Parliament. So these figures we're looking at are only for income tax computation. So it would impact you on salary and then sole trade profit, but not on dividend.
Not dividends. Excellent. Thank you very much for clarifying. Perfect. Okay, so moving on to efficiencies for the new tax year. It's going to follow more or less the same advice, although there are a couple of changes here that you should be aware of. So we're still following the secondary threshold salary recommendation, so 758.33, because that threshold hasn't changed. You can even issue dividends up to the same value as well. That's also remains the same. So effectively, you get a combined earning then as a director of 50,270. The one thing obviously that has and is going to change, and this is impacted by the, I believe, the reduction in the tax-free allowance for dividends, is the income tax. Is that right? So those two are the key things that are different here. Yes,
the dividend allowance is what's changing. So if you look at the salary figure, it hasn't changed. The dividend, the 41,170, still hasn't changed. What has basically changed is a £500 difference in the dividend allowance. And so you can see that the income tax has risen slightly to 3,255 compared to the previous slides we're looking at.
Yeah, so previously I think it was about 3,211, something like that. So it's about 40 odd pound, isn't it, that you're going to pay extra on income tax for self-assessment. Okay, so allowances and thresholds for sole traders. Michael, as you've just said, there has been some changes here as well. So I'll point over to you. In fact, it looks like there might have only been one change. The rest has all stayed pretty much the same from the looks of it.
Yeah, the main change is what we've already talked about, which is the reduction in the class 4 NI contribution rate from the 9% down to the 6%. That's the main change. Everything else is basically the same. The only thing to add on is that the class 2 NI, which is a voluntary contribution, which is a £3.45 per week. That's now, if your profit is less than 6,725, then you have to make a voluntary contribution if you want to. So if you don't want to, you don't need to make that payment. However, we would recommend you make that payment, especially if the sole trade business is your sole income, because making a voluntary contribution would mean that you still count the tax year as qualifying for state pension entitlement. So if you take, let's say, a limited company director who also has a sole trade business on the side, they might be getting, let's say, the 9,100 in, let's say, salary. That alone qualifies them for state pension entitlement. They don't need to make the voluntary class 2 contribution.
Okay.
But then if you take one who only has a sole trade business and their profits is less than the 6,725, then it will be recommended they make that contribution so that that tax year qualifies for state pension.
Okay, perfect. Okay, so that's definitely something to consider. Excellent. Now, for sole traders, I'm aware that as we've been talking through this, that we can all see that there's benefits to limited companies and how it is they can be tax efficient through that business. For sole traders, obviously, you're quite limited, I would say, in terms of what you can and can't do with how you earn money through your business, because generally speaking, because you don't do things like company accounts or you don't have directors and shareholders in which you can pay dividends to and things of that nature. Sole traders generally will only do a self-assessment to report their income. Obviously, there are some things they can do, like we touched on, expenses being one of the big ones, making sure that you claim them so that you get deductions, so that it reduces your tax bill. But Michael included some information on this earlier, which should be considered as well, because perhaps you're thinking to yourself now, well, is it better for me to go limited if I'm a sole trader? So Michael's put some key points in here just for you all to have some, to think about, because there's pros and cons to both. I will say, obviously, the big advantage when you think about it in monetary terms is going limited, but there are some things that sole traders should be mindful of before taking that leap into limited. So Michael, I'll pass you over to briefly explain what these are.
Yeah, so with sole trader, they only need to file the tax return to HMRC, and then that's it. I think Luke has gone off.
No, I'm here. My internet's having a blip.
Yeah. So sole traders have greater privacy because they file a tax return which is not visible to any other person apart from the taxman. The limited company, you've got to file your company accounts, and then you file your company tax return as well. The company accounts, anyone can go into the company's house and then obviously see that bit. The sole trader, because they only file one document as well, it's basically cheaper in terms of the administrative purpose and the rest. It's also simpler to do. It's income less expenses, and that's it. Whereas doing limited company accounts are a bit more complex. So yeah, it's less work for a sole trader and more for a limited company. That's where some of the tax efficiencies come through.
So student and postgraduate loan repayments, I guess I'll point back to you as well, Michael. Yeah. I mean, it looks like there's a couple of things. Actually, there's a few things here that are worth noting, particularly with rises. Yeah. So I'll point over to you again for student loans and postgraduate.
Yes, so there's been slight increments in the Plan 1 from the 22,015 in the previous year to 24,990. And then Plan 4 as well, that's the one applicable to Scottish students, has also increased. There were no changes to that of the postgraduate loan. So yeah, the only changes apply to the student loan sections.
Okay, brilliant. And apologies again, I can tell that I'm having internet issues because everything's turning a little bit robotic. So apologies if I drop out again. Let's move on though. So we've got childcare and child benefits changes. Now there has been some big changes for this one in particular. So we've got an announcement from the government that 30 hours per week of free childcare for up to 38 weeks in a year for children between 9 months to 3 years. Now, I don't know if there's a specific date in mind. The last I'd heard, it was they just sort of left it quite vague as April 24. But I don't know, Michael, if there is a more definitive date that they've put in. Is it the start of April or is it new tax year?
Yeah,
I think they might not know.
They just said April, but I think they are doing it in phases. So something starts part of it starts in April, then the next bit will come in. I think it's September or so as well. Okay. So it's in phases,
Right. Okay. And it looks like there's quite a big change here to the child benefit threshold. So that's gone from 50 to 60 for the lower threshold, and then from 60 to 80 for the upper threshold. What should people be mindful of about this? Because I thought not only did the threshold change, wasn't there another change that went hand in hand with this, or is it just threshold changes?
No, it's just the threshold changes. So what I think most people on here should take from this is that if you stopped your claims, you should probably look at restarting it in the new tax year, because most people would have been earning probably above the 50,000 anyway, and then usually they would have stopped it anyway. I think what the government also talked about, they are going to consult on it, but I think that's going to come in 2026, is that rather than looking at an individual's income, they would much rather look at the household income to try and then equal things out. But that's currently in a consultation for now. So we'll know more about it in a year or two's time.
Okay. All right. Excellent. As always, if there are any significant changes, we generally send out things like newsletters and emails and operational updates and things as well. So it's worth either, if you're not already a Crunch client, signing up to our Crunch Chorus group. You've got the forums and things that we operate as well. So if you want to stay in the know, definitely have a look at those. And of course, you've got our main Crunch Knowledge website, which is regularly updated with any changes and updates. So I think we're on the last few now. I know we've got a couple of minutes left, so we'll try and get through these, and we'll see how we're doing for time with any questions for those that may want to stick around for a little longer. But claiming expenses for cars or vans. Now, for sole traders, we generally only recommend claiming for costs for like things like tools of trade vehicles. Otherwise, you're much better doing mileage in that case. So you claim your mileage allowance. Michael, can you remind us what the mileage rates are, what the allowances are? I think, is it 45 pence up to 10,000 miles?
Yeah, and then 25p after.
25p after that as well. And is that true for bikes as well? I thought
bikes is, I think, 24p per mile off the top of my head.
Yeah,
I need to triple check on that. Yeah, but bikes is either 24p per mile or 25p per mile.
Okay, excellent. And for limited companies, we touched on this earlier with the P11D conversation around benefits in kind. Now, company cars, so if you do have a company vehicle, it was bought by the company, but you're using it personally, it's then deemed as a sort of a perk. Okay, it's a benefit. It's something that you're receiving on top of your regular salary payments. Now, there are a couple of things here that haven't changed. So fuel for company cars provided for personal use remains unchanged. The company vans remains unchanged, and the fuel as well remains unchanged. Now, one thing to point out here is another question we do get quite a lot is, do you claim for fuel or do you claim for mileage? Michael, I think there's one relatively straightforward rule here, is that if it is a company car, so therefore it's owned by the business, it's in the company's name, you claim for the fuel, you claim for the petrol cost or the diesel cost or whatever. You just claim the whole cost of that.
Yes, the company rightfully pays for the full cost of, let's say, fuel or whatever it is. But because you are using it personally for your own stuff and the rest, there is also a bit of benefits in kind in there that needs to be repaid. So if, assuming you've worked out that, okay, I've basically used it for this personal trip or whatever, this is how much it cost in the mileage and the rest, I will pay back that money into the company, then you're all square. If you don't pay it back into the company, then it's technically a benefits in kind that needs to go onto your P11D.
Right, got you. And can we just confirm, I've got a quick question down here, just for clarity over the 757 for company vans. So company vans remains unchanged at 757. What does that relate to exactly? Is that the amount you can claim?
No, it's the value of the benefits in kind. So what the taxman or what HMRC basically does is that they set the rates of what these benefits are valued. So year on year, they are basically increasing the thresholds or reducing it based on, I don't know, what they feel like it's the appropriate value.
Right. Okay. Okay. Brilliant. And I suppose that's similar for is it similar for cars as well? Then in that case, it's just higher on cars.
Yes. So the car, they use that value of the 27,800, and then it's basically, that's what we call a list price, and the list price is then multiplied by a percentage of based on the emissions of the vehicle and that kind of stuff. So it's
right.
a bit more complex, but there is a price you multiply by a percentage. So the price is usually this 27,800, and there's a percentage that goes with it based on the emissions of the vehicle or the range it travels as well, depending on whether it's electric and the rest. So yeah.
Okay. Okay. So there's a fair few variables then. When it comes to company cars in particular, with emission rates and values and stuff like that. So again, do be mindful that there's more information about these, of course, in any of these slides with additional links and resources. So absolutely, once you've got the follow-up email from us, you'll have access to all of this for more info should you need it. Now, this is the last slide before we close off. Now, this is something that is probably going to come as a bit of a shock to a lot of you. It certainly did us when it came into effect, because there's a significant jump and changes in the way that companies house are now charging for some things when they weren't before, and also the cost increase for some things that have been in place for years. I mean, the big one for me is the confirmation statement that we spoke about earlier. Certainly for as long as I've been at Crunch, it's always been £13. And that's going up now to £34. So these are things that you should be aware of. So first of all, for anyone that is considering starting a new business, there is going to be incorporation fees now. So to start, this goes into effect from the 1st of May. So it's 50 quid now for an incorporation of business, or if you need it the same day, it is a service they offer, but it's going to be £78. If you need to change company name, that's going from 8 to 20. Confirmation statement that I just spoke about is going from 13 to 34. I mean, you kind of think after 7 years they just do incremental price rises, but evidently they think one fell swoop is the way to go. Reduction of share capital. Now, this could be something that impacts a fair few of you, especially if I've seen in my time when people do incorporate businesses, they give themselves, I think it's quite a ludicrous amount of shares. So they'll start with 10,000 shares. They might have something like the nominal value at a penny or something like that. But then that does mean sometimes if you bring on a new shareholder or you increase the share value or anything, you end up having to try and balance it back out by reducing shares. Beforehand, you could do this without a fee. Now, unfortunately, every time you do it, it's a £33 charge. So do be mindful of that. If you are starting a business, the easiest way to do it, I think our advice generally is to start with start a share number that's small but easily dividable. You know, so if you are going to start a business, have a share capital of like 10 or 20 or something, but then keep the nominal value relatively low. That way you can increase it. You don't then have to pay this fee. And you can, of course, split easily dividable if you do bring on new people as well. And the last one really is strike off. So if you are looking to wind down your business, you're looking to close it all off, that fee is also increasing now with Companies House from 8 to 33. So as we can see, that the ones we've got here, it's worth pointing out, are the ones that we felt were like going to affect the majority. However, there's quite an extensive list on their website with some other changes as well, as pointed out in the source at the bottom right. So do check that over to see if you're going to be impacted with any changes that you may want to make in your business as well. Okay, so only just slightly over, not too bad actually, not too bad at all. Hopefully everyone here has found this helpful and informative. I can see that there's a number of questions that you've all been helping each other with, which is absolutely brilliant. Thank you so much for doing that. I think maybe if we've got a few moments, Michael, or you do, shall I have a quick look through and see if we can answer any questions now for the last sort of 5 minutes? Yeah, let's have a quick look. Right, what have we got? Here we go. Fern says, can I claim childcare as a business expense?
No.
No. Short and sweet answer. Love it. There you go.
Question is, it goes back to the slide we're talking about wholly and exclusively for business. Question you then have to ask yourself is, what has the childcare got to do with the business?
The business, yeah, that's a valid point.
There used to be the childcare voucher scheme, which a company could have set up for its employees, but that was basically stopped, I think, about 2-3 years ago. And then they moved on to the one where you basically contribute into a scheme and then the government tops up. But basically, yeah, it's a no.
They scrapped that, didn't they? Yeah. Okay. Let's see. Who else have we got? Justin. Let's see what Justin says. Are working from home utility bills claimable as an expense? Now, I know that there is a use of home spreadsheet that we have that can help you calculate certain things in terms of like proportional use and how much you can claim depending on the amount of time you spend and things like that.
Yeah, there are 2 ways we actually do this computation anyway. There's a simplified approach, which is where you claim the flat £6. So let's just say if it was an employee or director, you could claim the flat £6 a week. Okay. If you are a sole trader, you could claim, is it 10, 18 or 26 pounds per month, depending on how many hours you work. So that's what we call the simplified approach. The complex approach is where you then want to say that, okay, my house, basically I've got 5 rooms, I work maybe 9 to 6 or whatever. I work 7 days a week. And so that gets a bit more complicated. And we have a spreadsheet for that one that can basically help people compute it.
Okay, brilliant. And I suppose that I guess for maybe sole traders, because again, I think in some scenarios, things like bills, for example, so again, using the mobile phone as an example, if it's in the business name, generally you're going to be able to claim for it, right? But for sole traders, obviously they don't have that luxury. It's going to have to go into their own personal name.
Yes, but then the sole trader can also claim a proportion of that mobile phone bill. So if it's all down to the sole trader to estimate what proportion of their phone they use for personal and what they use for business. So if, for argument's sake, they can say that, okay, I use it 50% for my business, then you can claim the 50% of that bill.
Gotcha. And would there be any sort, I suppose, like an itemized bill? I mean, I know it's quite rare, but it can sometimes happen. HMRC can ask to see evidence and, you know, things like receipts. I mean, we'd always recommend keeping them, or at least keeping digital copies, even if you don't want to keep the paper, because, I mean, let's face it, if you've ever had a receipt in your wallet or purse for longer than a week, the ink's gone. So how, I suppose, would they evidence should that happen? Would it be something like an itemized bill that they get from their provider?
Yeah, we all obviously get itemized bills digitally anyway. So that is a starting point. Don't also forget that sometimes we use more data as well for doing, research and all that kind of stuff, which you obviously can't quantify and the rest. So it's more of what do you call it? Something that's probably a bit of caution should be applied to when you're stating what percentage it is for business. But I don't think HMRC will lose sleep just chasing a few pennies and the rest. No.
Yeah. Well, you never know. You never know. Never know. I mean, I suppose, yeah, going back to things like expenses, there's a sort of, I guess there's a reasonableness applied to some of this stuff as well. You know, you could take something a bit more extravagant, you know, going back to things like even entertainment costs. If you're taking a client out for a business meal or something like that, you could argue, okay, it was a business meeting, there was an entertainment aspect to it, so that should be allowable. However, the reasonableness starts to drop off a little bit if they start to see that you've gone to a golf course afterwards and then you've gone to, you know, 3-course dinners and things. So there is a bit of sensibleness there, of course. So just making sure that those expenses are obviously legitimate, allowable, and within reason as well. Okay, cool. I think we should probably wrap it up there. I know that there's a fair few of you still around, so thank you very, very much for all of your time today. I do, again, Michael and I really hope you found this helpful. We are going to be sending a follow-up. So to everybody that's registered, don't panic. You're going to get an email from us. It's going to contain the recording. It will contain the presentation. And it will also contain all of the resources that we've seen throughout this session as well, so that you can do a bit more research if you need to. Don't forget, if you are a Crunch client, we're always here to answer questions. If you're not a Crunch client and you want to get some, you want to find out more about us, Crunch, if you want to know whether is going limited right for you as a sole trader, call our advisors and they will happily speak to you about it as well. But again, thank you all very, very, very much. I hope you have a fantastic day, and hopefully you do have the Easter weekend, and therefore I hope you enjoy a long weekend as well. But all the very best to you all. Thank you. I'll pass you over to Michael for final sign off.
Thank you. Thank you, everyone.
Cheers then. Take care, everyone.